Welcome to Breaking News to Trading Moves. Today we're jumping right into a specific headline and, walking through the market winners and losers based on the data.
Yeah, glad to be here. We've got a lot of market data and earnings transcripts to go through today.
Right, so the headline we are looking at is this. Tesla reported quarter one vehicle sales of 358,023.
Hmm.
And, well, you might look at that and say that number is actually up 6% year over year. But it falls below the roughly 381,000 that analysts were expecting.
Yeah, and the market reaction to that miss was pretty immediate. We saw the stock sell off right following the update.
Exactly. And the nuance here is that Tesla is actively trying to move investor focus away from near-term car sales.
Right, you have other projects.
Yeah. If you listen to their executives, they want the market to look toward their cheaper models, the robotaxis and, the Optimus project.
But the focus today is simply understanding the headline itself, establishing a really calm, analytical tone here. We just want to map out the specific companies categorized as winners and losers based on this data.
Right.
We're going strictly by the numbers to see how capital reallocates when Wall Street's expectations kind of, well, collide with actual physical delivery reality.
Perfect. So let's start right at the epicenter of the headline to look at the immediate losers.
Makes sense.
Obviously, we are talking about Tesla itself, but also these sentiment trades. The data shows sales were sharply below the prior quarter. So we are looking at TSLA, which is Tesla, and ARKK, the ARK Innovation ETF.
Yet to really understand why a miss of just a few thousand cars triggers such a fierce reaction, you have to look at the mechanics of sentiment trades.
Okay. How so?
Well, when a stock's valuation is built more on future narratives than current earnings, delivery misses just matter a lot to the market.
It's like a startup being judged on a grand multi-year vision versus a traditional business being judged on the cash register receipts at the end of the week.
That is a great way to look at it.
So are we seeing a moment where the market is strictly demanding the receipts?
We absolutely are. When you evaluate a traditional company, the stock price reflects what the company is doing today, right?
Okay.
But with TSLA, or the company's inside ARKK, investors are paying a premium today for cash flow that is supposed to materialize, 5 or 10 years down the road.
And if they can't hit basic manufacturing targets right now, the market aggressively discounts that future narrative.
Exactly. So that premium just evaporates.
Wow. Okay, so from the vehicles themselves, let's move to the components that power them. The extended losers.
Yeah, the underlying ecosystem.
Right. If the main player is selling fewer units than expected, the whole ecosystem feels the pressure. Let's look at EV charging first.
This is like really capital-intensive area.
Yeah, the data shows slower or more uneven EV adoption puts pressure on charging networks. Their long-term growth depends strictly on more EVs getting sold and driven. We are looking at CHPT, which is ChargePoint, and EVGO, EVgo.
Because think about what these companies actually have to do. They spend a massive amount of capital up front.
Leasing real estate, trenching concrete, all that.
Exactly. So they rely on utilization rates.
Yeah.
They need a specific volume of cars pulling up to those chargers just to break even.
It's a volume game. And what about battery materials? We've got Tesla struggling to meet expectations, plus competition taking market share, leading to market worries.
Oh, the mining side is brutal.
Yeah, this means softer demand growth for battery materials, weaker EV production momentum, and pricing pressure across the supply chain. The tickers here are ALB, Albemarle, and PLL, Piedmont Lithium.
Right, because commodity markets price on the margin.
Wait, let me ask a clarifying question about the math of the supply chain here.
Sure, go ahead.
If fewer consumers are buying the premium cars, fewer people need the chargers and lithium. It's a very straightforward equation for the supply chain, right?
It really is.
Yeah.
It is that simple. If global supply exceeds immediate demand by just a tiny amount, buyers get all the leverage and prices drop.
Okay, so that is the pressure side. But while the pure EV ecosystem faces pressure, softer premium demand opens up avenues for alternatives.
Right, capital has to go somewhere.
Exactly. We need to look at who benefits when consumers hesitate. Let's start with traditional auto.
This is where you see a lot of rotation.
The data shows investors may rotate toward car makers with more diversified revenue and broader model lineups. They suffer less dependence on a single EV narrative and are leaning into hybrids or a balanced rollout.
Yeah, the legacy safety net.
The tickers to watch are GM, General Motors, and F, Ford Motor. It's like going to a restaurant known for one premium specialty dish.
Oh, I like this analogy.
If diners aren't buying that dish right now, the spot next door with a massive varied menu or the budget-friendly place down the street, suddenly gets the foot traffic.
That is exactly what happens.
Well,
Ford or General Motors can just pivot a hesitant consumer right into a hybrid instead.
they capture the revenue either way. And speaking of the budget-friendly place, what about used car platforms?
Yeah, the ultimate budget option.
If EV demand stays softer than hoped, consumers lean toward used vehicles or cheaper alternatives instead of new premium EVs, and that supports dealers and used car marketplaces.
Because people still have to commute, right?
Right. The tickers here are KMX, CarMax, and AN, AutoNation.
They thrive on inventory turnover. If new car sales slow down, the foot traffic on the used car lot naturally increases.
They just keep everyday consumers moving. Okay, so we've covered traditional auto and used cars as winners, but there's one more category, mobility platforms.
This one is really compelling.
Yeah, we mentioned earlier that Tesla wants to focus on robotaxis. But if the market focuses on weaker auto fundamentals instead, we have to look at the companies Tesla was supposedly going to disrupt.
Right, the ride-hailing companies.
We're looking at Uber, Uber, and LYFT, Lyft. The data shows Tesla's valuation still reflects a lot of optimism around a robotaxi-led transportation model.
It does. But if the market is focusing on weaker auto fundamentals right now, those robotaxi expectations really cool down.
Okay.
And that reduces pressure on ride-hailing names that might otherwise be seen as future disruption targets. The market essentially stops penalizing them for that future threat.
So let me get this straight. Does this mean the current ride-hailing leaders get a breather from the looming threat of an autonomous fleet, at least in the eyes of the current market?
They absolutely get a breather. It's a timeline extension. Investors push the arrival of the robotaxi further out.
Oh, wow. So their stock benefits just because the worst-case scenario gets delayed.
Exactly.
Yeah.
It relieves that constant downward pressure on their valuation.
That is fascinating. Well, let me just briefly recap the journey of today's episode for you listening. We walked through the headline, Tesla missing Q1 delivery expectations despite year-over-year growth. And we reviewed the list of winners. That was traditional auto, used cars, and ride-hailing.
Right.
And the losers, which were Tesla, EV infrastructure, and battery materials. All strictly based on the numbers without exaggerating the outcomes.
Yeah, it's a very mechanical reaction across the market. But I do want to leave you with a final thought to ponder based on everything we mapped out today.
Go for it.
How long can a company rely on future narratives, like Optimus and robotaxis, when the market actively demands present-day delivery results?
That is a great question to leave off on. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.